I think that the given growth that we described earlier in the interview is I think pretty sanguine. So we're obviously looking for catalysts to add to our exposure. When a company says they're going to do something and they do it, then to answer your question, we give them a really big plus in our scoring process. So NAB for me at the moment, it's ticked off 2 of the major 3 catalysts, and that means I'm prepared to still stay in there for the next one to be ticked and hopefully cash in on a higher price. Given that the stock's fallen, all the stocks in the banking sector have fallen aggressively because of rights issues and just the general malaise in the market, we'd still say that NAB would probably be the stock we'd hold overweight, but in an otherwise underweight bank sector at the moment. Our economists both feel that there's another couple of rate cuts coming, so Jared Minack and Steve Roberts. I think it's because of what I'm saying. There's definite parts of the economy, sectors that we haven't been exposed to because we've seen it coming. So domestic spending is really low. As a result, we haven't been exposed to the retail market other than Wesfarmers. No retail stock exposure at all. That's been a great thing. And if you think about wage growth in Australia, it's running at the lowest level, for 20 years. So in other words, the basket of goods is actually increasing at a higher rate than the wages growth increase. And that's tough. The average consumer is finding it really hard out there. So I think that the rate cuts are there to help other parts of the economy that is not related to property. And then you've got APRA on the other side of the coin saying, guys, banks, we want your risk-weighted asset test coming up. You're going to have to set more equity down, hence the capital raisings. And at the end of the day, that's a given that the banks are going to be able to prosper on that, put up the interest rates for both the local, for the investor loans first, and then maybe even for owner occupiers, which will come as a shock to people. And so are there any more, to answer fully the question, are there any more raisings to come? The set ratios now on an adjusted value are all up around 9.5, 10. Eventually, by 2018, they're going to need to be up around 12%, 11.5, 12. So yeah, there's a bit more to come, but the bulk of it's done. So where we are in the cycle for banks, because they're getting, they're obviously, it's harder on the deposit side for them to get the money in because rates are so low. But on the other side, they're going to start to make a little bit of money on the credit side when they're extending credit at higher rates. But again, that's tempered by less people taking up loans. So it's not a great picture for the banks. It's not a disastrous picture for the banks. So if there's someone out there looking for 6 or 7% yield, which was 5 or 6% a few weeks ago, it's probably a good place to put a little bit of money if you're not more than, say, 30% exposed.